So here's a quick portfolio update with Questrade. So my equity now is down to 102.68. I did withdraw about $7,000 from my TFSA to pay some taxes, sadly. So if we look at the positions in each of my account, in my margin account, the only position I have open right now is a naked put on Rocket. It was an earnings trade I had done maybe 2 weeks ago, 23 short put. Collected $1. It was profitable most of the time, but I didn't want to close it. I wanted to hold on to it till expiration because I'm not worried. Even if it gets tested, I'm just going to roll it. And I'm going to upload a video on how to roll a naked put soon. But this is the only position I have left on in my margin account. This week was only earnings trades. I was in and out basically before the close, before earnings was announced, and then I closed the trade at the open after earnings was announced. In my TFSA, so if you remember, I think I had about almost 68,000 Canadian of value. So now it's down to 55, and I decided to buy some stocks, but in small portions, in small chunks, because I don't know what's going to happen. I don't know if the stock market's going to go up, if it's going to go down, but I know cash is going to lose value. So I have to invest in something. So for the moment, I want to do a little bit of dividends. So I decided to buy some dividend stock. So I bought Bell, I bought Bank of Nova Scotia, I bought Pizza, and I bought TD. And I put exactly $1,000 in each. Now they each pay over 5% dividends, and they all have consistent dividend growth, except for Pizza. Pizza is more of a royalty. It's a fixed amount, and it actually dropped after the crash, but it still pays over 6% dividend. And I feel the price is not far compared to the March lows. So that's why I bought some, and I only put in $1,000 anyways. And I think the best way to prepare for in case of a stock market crash is to always have enough cash available to buy more in case the market drops, so you can dollar cost average. Since I don't know if this is the lowest price or not. For example, on TD I bought it at 63, but if it drops to 50, I'll buy maybe some more because I still like TD regardless of the price. So now my average cost will be around 57, 56. I think putting in the whole amount in one stock right away might be a little bit dangerous. I was thinking of buying 100 shares of gold, which is I think right now trading at around, here let's look at it, I think it was trading at 183. So yeah, 183. So if I buy 100 shares, that's 18,300. So I have the capital for it. I was thinking of doing covered calls on it every week, out of the money covered call. So for example, if I wanted to buy it today and then sell an out of the money covered call or an out of the money call option for September 25th, I could go to 186 strike and collect 50 cents. So it allows me to collect an income on my position regardless of what this position is doing. If it's up or down, I'm generating something from it. And by selling the 186 strike, which is $3 away, I'm basically hoping that it doesn't go above 186 by September 25th. So I keep my shares and I keep the premiums. But if it goes above 186, then I have to sell my shares at 186. I made a profit, yes, but now what do? I'm left with the same position. I have cash and I want to invest it. So do I buy back in at a higher price? So the idea is not to let your shares get called away and to always sell maybe out of the money calls so that you don't lose your shares. But I'm not too sure if I want to put 18,000 right away in one position. I'd rather buy things gradually, because in March, even when the stocks were crashing, here let's look up the gold chart. Even when stocks were crashing in March, gold dropped. Usually gold is supposed to do the opposite. So here GLD dropped from 157 to 138. So if stocks are crashing, isn't gold supposed to go up? But it also crashed. So I don't think it's exempted from any stock market crashes. I think it could crash even if the general market crashes, because we saw it in March, even though it's supposed to be a protection. In my RSP, I had three covered call positions. One of them was Micron. I got rid of it this week because it jumped up and I wasn't able to collect enough premiums from it, and I didn't want to cross earnings, which was in 2 weeks. So I could have gone to September, not September 25th, but the week after, which is October 2nd. So I could have gone to an October 2nd expiry on Micron and collected a decent premium, but then I'd be stuck with earnings. And like Intel, if I go to my RESP, Intel, I got stuck with earnings. I bought it at 58 and then the stock dropped to 48. I collected premiums on the way, but earnings destroyed the position. Now, I don't think that's going to happen with Micron, but just in case, I thought it would be safer to just get my cash back. So I got in I got in August 13, I got out September 16. So exactly 1 month. So I got in at 44.89. That's how much I paid at a 46 strike. So basically I collected $1.10 from the call option. That's why it brought my cost only to 44.89. And then I rolled it the week after. I collected 39 cents, and then I rolled it again 61 cents, and then I rolled it again 73 cents, and then I got out September 16 for 45.95, so almost $46. So basically premiums collected on this is about $2.80. If I add the premiums up, it gives me about $2.80, and I had a net cost of about, let's say, 46. So that's about 6% in 1 month. So annualized, that's 73% per year. So Micron trade, I collected 6% in 1 month just by selling covered calls. So I still have 2 other positions. I've got IWM that I've had since February, and I keep just selling premiums on it. I'm having fun. I hope I don't get burned, but I keep collecting some nice premiums on IWM. $1, $1.25, $1.10, 58 cents, 90 cents, $1.40, 90 cents, 96, 70, and just keeps going. And so for example, this $1.04 that I collected this week for September 25th expiry, that represents about, let's see, annualize what kind of return that is. So $1.04 divided by 52 is 0.6% per week times 52. That's about 35%. So I'm collecting on average 35% annualized on a position that, if you look at the cost, my cost is 151. The stock's trading at 152.86. Yet I'm generating almost 35% a year from this position by selling covered calls. Now the risk is if the stock drops to 140, 130, then it's too far away from my cost. Which strike will I choose? The 152 strike will not have enough premiums, and that's the problem. Now I have to risk selling at a lower strike. Now that's what happened with Virgin Galactic. I bought at 23.62. It dropped to 17, even 16. So I'm selling at the same strike of 23 or 23.5, but I had to go very far to collect some decent premiums. So the last trade I made, I collected 43 cents, but I had to go all the way out to October 16. Plus, I chose a 50-cent lower strike. I went with a 23 strike instead of a 23.5 strike. So if I go to orders, SPCE, you could see that there's nothing I executed. All right, so I bought in at about 22. So 23.5 strike, I bought in at 22, so I collected $1.50 the first time. And then I rolled it from August 7th to August 21st, collected 30 cents. And then I rolled it from August 21st to September 25th, 65 cents. So as you can see, I'm going very far just to collect 65 cents. And then I went from September 25th to October 16, collected 40 cents. So that's the risk with covered calls, is you're still long 100 shares. So if the shares drop, you can't find premiums. And finally, in my RSP, I've got a covered call on Intel and a few extra shares, 20 shares. So I initially bought at 58, and then I bought some more at 49. So I lowered my cost basis to 56.25. Now I'm selling covered calls at a 56 strike. The last one I have here is for October 23rd, collected 67 cents. So this one is, so that's the proof of the dangers of covered calls, is if the stock drops, you're selling very little premiums and you have to go further out. As opposed to the stock trading very close to your original cost basis, then you can collect higher premiums. So that's what's in my portfolio. I'm going to continue doing selling options in my margin account, put spreads, maybe naked calls, but mostly earning plays. I might also do a trade on Tesla, so I'm gonna do a video on my next week trades. I'll upload it soon. I'll be talking about which trades I'm looking to make next week, but in general, in my margin account, it'll be option selling strategies, put spreads, and naked calls. In my TFSA for the moment, I'm going for basically trying to buy the dip on stocks that drop, that look relatively cheap with dividends. It has to have dividends. I'm trying to go with a more passive approach in my TFSA, because anyways, if I wasn't doing anything with it, it was just cash that's used as leverage so I can trade in my margin account. So it doesn't matter what I'm doing with it, as long as it doesn't lose too much value. So I still have leverage in my margin account to sell options. I just want to invest it in something that does something. So these positions, they have dividends at least. I would also like to do covered calls, but it's important to get a good entry with covered calls on the stock that I choose. These ones don't have enough premiums to do covered calls on them. So covered calls would have to be on a stock that's a bit more volatile, not as safe as these ones. So in my TFSA, I've sold the Micron, so I've got about 8,600 US available buying power. I was thinking of buying Slack, actually doing a covered call on work. Let's see what it's trading at. Yesterday I think it was trading at 25. Must have dropped today. Oh no, same price, 25. So I could do a covered call, let's say, for next week, for September 25th. And there you go. I could pay 24.37 or 24.40 to get into the 25 strike. Or if I want to keep it forever, then what I would want to do is buy the shares and then sell a call option out of the money. And the furthest I can go is around maybe 27 strike, collect 20 cents, just to make sure that my shares don't get called away. But if I want the most premium upfront, I don't care about holding the shares long term, then I could go with the 25 strike. I think that could be a good idea, actually. Collect 79 cents. 79 divided by 25, or 80 divided by 2500, let's say. That gives me a 3.2% per week. That's crazy. Annualized, that's 166% per year. Obviously, you're not going to be able to get that kind of premium every time, but this is how much it represents annually if you're able to get that kind of premium every time.